Good morning and welcome to the Esken Limited full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated on the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand over to David Shearer, Executive Chairman.
Welcome to our full year results presentation for the year to the end of February 2022. Despite the challenges which the business continued to face, this has been a year of progress and transition for the group. We continue to navigate the pandemic and simplify the business to position it for the recovery, and I look forward to talking you through our performance. We have streamlined our business to focus on profitable growth in the recently renamed Esken Renewables, support the recovery at LSA, and address residual legacy issues. Esken Renewables enjoyed a positive year following a full recovery in the construction sector after interruptions resulting from the first lockdown in the prior year. This led to an improvement in the availability of waste wood supplies and a consequent recovery in gate fees. The energy plants we supply have also matured, resulting in fewer unplanned outages. This meant we supplied 1.5 million tonnes of biomass fuel compared to 1.4 million in the prior year. London Southend Airport saw a continued drop in passenger numbers through the period of the pandemic, with passengers down 36% to 94,000. In that context, the adjusted EBITDA loss for the aviation business of 0.8 million, compared with a loss of 6.1 million in the prior year, should be seen as an achievement. That performance reflected the strict financial discipline, but also the impact of one-off contributions from Connect Airways and Teesside International Airport. The improved performance of our operating businesses resulted in a combined adjusted EBITDA of 19.5 million, compared with 3.9 million in the prior year. A reported loss before tax of 34.6 million also represents an improvement compared to 44.2 million reported in the prior year. That loss is after 19 million of financing costs, 20.5 million of depreciation, and 12.1 million of central costs, including 5.6 million of legal costs. These legal costs relate largely to residual legacy issues which we hope to conclude in the near term and will not recur. Streamlining our central costs and indirect costs in the operating businesses is a key focus for the current financial year. I would like to remind you of our medium-term objectives. We are aiming to grow the profitability of Esken Renewables, and you can see good progress in the last year. Our aim is to develop the profitability of the airport, and the key word here really is profitability, not volumes. We will not chase passenger numbers. Instead, we are focused on getting the right airline deals for a profitable and sustainable future as demand recovers. The airport has a compelling proposition in terms of operating cost, passenger experience, and ease of access by rail from central London. We are seeing passenger demand recover across the London airport market in summer 22, and capacity constraints will once again become an issue, particularly for peak time slots. These points support our discussions as we negotiate deals with airline and logistics partners where the economics makes commercial sense to both parties. ESG has been a key focus for this year, and I am pleased with the progress that the team have made. We have put in place an ESG governance structure with board oversight through the establishment of a sustainability committee to deliver our ESG framework. We have substantially completed our roadmap towards net zero with a clear process for data collection for our scope 1 to 3 carbon footprint, and expect to finalise our roadmap to net zero in FY23. We have established charity partnerships for each of the operating businesses, developed a volunteering framework, and have started to gather social impact metrics. And we have improved our diversity data and established safety KPIs. Bonus targets for executive and senior management will include achievement of ESG objectives as one measure. The progress through our ESG framework underpins our desire to play a key role in reducing the UK's carbon emissions through renewable energy and sustainable aviation, while supporting our strategic objective to drive shareholder value over the medium term.
Thank you, David, and good morning, everyone, and thank you for joining us today. I'm going to start by providing a financial summary of the business. Group revenue is £104.6 million, which is a 3.2% improvement on last year's, thanks to the recovery within Esken Renewables. EBITDA is a £10.3 million profit this year, which is a significant improvement on the £7.4 million loss last year. This is referred to as adjusted EBITDA because it excludes impairments, which are shown separately. We will take a look at the divisional performance on the next slide. Loss before tax of £34.6 million is a 21.7% improvement on last year, coming through from the improvement within EBITDA despite an increase in finance costs. Net debt, excluding IFRS 16, is £140.5 million, which includes £118.8 million of convertible debt within London Southend Airport. Headroom of £72.7 million represents cash of £52.7 million and a £20 million undrawn RCF facility. Next, we'll take a look at the divisional performance of both revenue and EBITDA. A reminder that these results are from continuing operations only, so they do not include Stobart Air and Proprius as a result of the liquidation of Stobart Air in the first half of the year, or Stobart Rail and Civils, which was disposed of last year, FY21. Once again, just to remind you, this is referred to as adjusted EBITDA because it excludes impairments which fall outside the acronym of EBITDA. Overall revenue has increased from £101.4 million to £104.6 million, and EBITDA has increased from a £7.4 million loss to a £10.3 million profit. Aviation continues to be impacted by COVID-19, resulting in a reduction in passenger numbers, which in turn has led to a reduction in revenues of 5.4% to £23.4 million. Aviation EBITDA, however, has been less impacted as we have a £3.5 million one-off benefit of receipts relating to Connect Airways and Teesside International Airport. Renewables, conversely, has seen a return to pre-COVID-19 levels, with strong gate fees and tonnes supplied up 4.8% to 1.5 million this year. This has increased their revenue to £79.7 million and EBITDA to £20.3 million, which is a 103% increase on last year, which of course was impacted by the first lockdown and no construction activity in Q1 FY21. Non-strategic infrastructure has a £4.7 million one-off benefit from a property lease liability and provisions reassessment, following the exiting of a long-term lease. An agreement was reached pre-year-end to terminate the lease early and settle all provisions for a one-off cash payment of £1.2 million, which was settled in March 2022. Group Central has incurred legal costs this year, which are not expected to recur at the same level going forwards. Starting with the £7.4 million loss last year, we can see that the two main operating divisions, Aviation and Esken Renewables, have both delivered an improvement, which is partly offset by the increase in central costs. As you can see, we have highlighted the one-off benefits in aviation and non-strategic infrastructure as mentioned on the previous slide. Overall, this results in a profit of £10.3 million for the year, or a £2.1 million on a more like-for-like basis, excluding the one-off benefits. This bridge shows the movement from adjusted EBITDA, £10.3 million, to the loss for the year of £27.1 million, and has been colour-coded to allow focus on the cash and non-cash items. Depreciation has increased slightly this year, following some asset investment at London Southend Airport. Impairment is the net of a £6.2 million right-of-use asset impairment within Esken Renewables, and a £0.8 million impairment reversal on a non-core asset in non-strategic infrastructure. The cash finance cost of £8.6 million is £9 million of interest payable on leases and debt, less £0.4 million cash interest received. The non-cash amount of £10.4 million is the release of debt issue costs of £5.8 million, interest capitalised of £6.4 million, and foreign exchange losses of £0.5 million. These are partly offset by the £1.6 million de-recognition of a financial liability and £0.3 million of other income. This brings us to a loss before tax of £34.6 million compared to a loss of £44.2 million last year. Tax is a £9.9 million credit, mainly due to the release of tax provisions. This means the continuing operations loss for the year is £24.7 million. Including discontinued businesses, total loss of the year is £27.1 million, of which £26.4 million is non-cash. Here we can see the main movements in cash for the year. We successfully generated proceeds of £52.3 million from the equity raise and £111.5 million from the convertible debt, which was mainly used to repay the RCF facility. Grants of £2.6 million were received by London Southend Airport. Repayment of debt, which includes the RCF facility, leases and interest, totaled £84.2 million. £3 million was spent on an improvement at LSA. After other small improvements totaling £0.6 million and before the impact of discontinued, the cash balance is £92.2 million, including the impact of discontinued, which is mainly Stobart Air and Proprius. The final cash balance at year end was £52.7 million. Next, we have the balance sheet, where overall net assets have increased by £21.8 million to £70.1 million. Tangible assets and right-of-use assets have reduced to the usual depreciation and the £6.2 million impairment of a right-of-use asset within the renewables business. Current assets have reduced as Stobart Air inventory and trade and other debtors were removed from the balance sheet following the liquidation. Cash increased as the funding raised was in excess of the RCF repayment. Loans and borrowings increased as the RCF, which was on the books at £52.3 million last year end, although it was drawn at £108 million when it was settled, is replaced with a convertible loan of £118.8 million. IFRS 16 lease liabilities decreased following the removal of Stobart Air balances and the repayment of leases. Other liabilities decreased following the liquidation of Stobart Air as their trade and other payables were removed from the balance sheet. Gearing, excluding the impact of IFRS 16, has increased slightly from 121.3% to 124.7%. With IFRS 16 included, overall gearing reduced from 519.2% to 344.9%. This slide shows the movement in net debt, starting with £250.8 million from last year end. The most significant movement was the £52.3 million net cash generated from the capital raise. Other large movements are cash interest paid and accrued interest capitalised on the convertible debt. The release of debt issue costs on the RCF, bond and convertible debt totaled £5.8 million and £1.5 million of costs were reclassified from debt to other debtors. New asset-backed leases of £1.6 million were entered into by Esken Renewables. IFRS 16 leases increased by £4.1 million due to contractual rent reviews. The net debt, excluding discontinued, is £223.9 million. And including the impact of Stobart Air, Proprius and Stobart Rail, the closing net debt position in February 2022 is £241.9 million, an overall reduction of £8.9 million. To help investors, we outline the debt timelines for the group on this slide. First of all, before we do the debt timelines, let's understand the undrawn RCF of £20 million will expire in February 2023. Now moving on to debt. The net debt of £241.9 million is broken out as per the previous slide, but now let's talk through some key dates for this debt. Other lease liabilities of £22 million will be payable over the normal course of business with various end dates. IFRS 16 was split between other and Proprius to highlight the £27.2 million, which will come to an end in September 2023. The bond of £52.4 million, which will mature in May 2024, is partially backed by shares we own in LGG plc. The convertible loan, which matures in August 2028, unless it were to be converted or redeemed earlier. I will now pass to Nick Dilworth to discuss the performance of Esken Renewables.
Esken Renewables delivered 20.3 million EBITDA, up over 100% on the prior year and slightly ahead of expectations. This is a tremendous result, and I would like to thank the team, led by its CEO, Richard Jenkins, for all their hard work in delivering this result. I should mention now that I'm going to be referring to Esken Renewables and not Stobart Energy, following on from our change of name in April. This was partly due to the sale of Stobart brands back in 2020 and our contractual obligations resulting from that. More importantly, it also means that we have a name that reflects our focus area, supplying renewable fuel to the UK. Our performance this year follows the stabilisation of waste wood supply from the construction sector, following the interruptions from the pandemic and the first lockdown, which led to the closure of household waste and recycling centres. This meant there was improved availability of waste wood and recovery in gate fees. Continuing stability in gate fees and normalised price structures are expected to continue as we leave the interruptions experienced from COVID behind us. Demand has also been more consistent, with commissioned biomass plants now focusing on optimising operational performance, which will continue over the coming years. Fewer unplanned outages and stable demand meant we could supply 1.5 million tonnes of biomass fuel compared to 1.4 million tonnes in the prior year. On the expectation that we're able to maintain that volume of supply or more, we believe Esken Renewables will generate in excess of 22 million EBITDA in the current financial year. On the next slide, I thought it would be helpful to give a bit more colour on the makeup of our supply and the performance of gate fees. While we supplied 1.5 million tonnes in the year, we have contracts to supply up to 1.7 million tonnes. And with plants becoming more mature, our expectation is that we will continue to move closer to that contracted supply volume. Broadly speaking, a third of the volume is accepted by us at our storage and processing sites as unprocessed volume from our supply chain, with the risings from the construction sector and household waste recycling sites. A further third of our biomass is secured from third parties that supply processed waste wood to us in areas where we don't have our own processing sites. The remaining biomass fuel that we supply is sourced from managed woodlands and forestry byproducts. This is made up of branches and bark residues from areas that have been felled for use in the manufacture of furniture, for example. The majority of this volume is sourced through our strategic partner, A.W. Jenkinson. It is the unprocessed waste wood accepted into our storage and processing sites that we charge a gate fee to receive. We then process this waste wood before supplying it to our plant customers. As you can see on the chart on this slide, gate fees have been higher than in previous years that were affected by the pandemic. The fees are also seasonal in nature, and the highest prices come in the summer. This essentially tracks the increased volume of construction in the summer and the resulting increased generation of waste wood. In addition to the seasonality, gate fees vary by region, with significant supply being generated in the southeast, given the relative construction activity compared to other areas in the UK. This slide helps us talk a bit more about our supply chain and infrastructure, illustrating how we are well positioned to support the supply of biomass fuel to our plant customers. Through the utilisation of our asset base and transport fleet, we can aggregate material and ensure we maximise value. For example, we can process material in the southeast where arisings are higher and gate fees can be stronger, and then utilise the product in our plants in the north. Aggregation of waste wood is a key strength for the business, which enables to meet our obligations for our index-linked, long-term exclusive contracts with our biomass plant customers. I also wanted to talk about the important benefits that our business brings to the UK. Esken Renewables undertook third-party research with Logica consultants. From that work, we are better able to understand the environmental impact of the business. Whilst Esken Renewables produced around 19,000 tonnes of greenhouse gas emissions in the financial year, it also saved the UK 630,000 tonnes of additional greenhouse gas emissions by avoiding in excess of 1.1 million tonnes of waste wood going to landfill, creating methane gas in turn. This is equivalent to taking around 136,000 cars off the road. The 1.1 million tonnes of waste wood and the fuel generated from forestry byproducts was used by our plant customers to generate 1.8 million megawatts per hour of electricity. That's enough to power 651,000 homes. When you combine the saving made by preventing waste wood from going to landfill with the benefits of generating energy from biomass plants instead of our fossil fuel-based energy generation, you're looking at saving the UK 1.3 million tonnes of greenhouse gases. That's the same amount of CO2 as you would generate from flying an A320 for 134 million kilometres. A flight from our very own LSA to Malaga is about 1,700 kilometres. So essentially, Esken Renewables and its partners are saving the UK from over 78,000 flights to Malaga a year. It is contributions like this that mean biomass fuel will remain a key part of the energy infrastructure within the UK. We will work closely with the wider sector to identify additional opportunities for the business to play an increasing role within the UK's circular economy and the journey towards net zero. I'm now going to hand over to Lewis Girdwood to discuss our aviation business.
That's great. Thank you, Nick. The past 2 years have been hugely challenging for the aviation sector. However, we are now starting to see the green shoots of recovery. Travel restrictions to many of the UK's most popular destinations have been relaxed, increasing the confidence of both airlines and passengers. Nevertheless, passenger volumes at London Southend Airport for this year reflect the challenges brought about by the pandemic and have continued to fall, with the airport welcoming 94,000 passengers compared to 147,000 passengers in the prior year. In the context of those challenges, I am, however, pleased with the performance of our aviation business. Adjusted EBITDA improved to a loss of £0.8 million compared to a loss of £6.1 million in the prior year. This performance is flattered by £3.5 million of one-off receipts associated with Connect Airways and Teesside International Airport. However, it does also include positive contributions from our check-in and baggage handling company, Star Handling, formerly Stobart Aviation Services, as well as the airport's hotel and solar farm. The airport has also benefited from strict financial discipline and income from our global logistics operation, although this operation has reduced in scale over the course of the year. It's worth flagging the local support our airport receives. We've worked hard to engage with our community over the last couple of years in particular, and it was great to see around 70% of local residents scoring the airport 10 out of 10 for favourability, with lots of people looking forward to a return to the airport offering summer holiday destinations. We are therefore, of course, pleased to now see the return of EasyJet flights to 3 summer destinations, Malaga, Palma and Faro. These are hugely popular, well-proven routes. Though we are still at an early stage of this operation, signs are encouraging. It is our expectation that the performance of these routes will help encourage EasyJet and other airlines to put on sale further flights for next summer and beyond. On this slide, we've tried to lay out why we're confident we can progress discussions for next summer and beyond. The first thing to say is that we are definitely located in the right place. We are seeking to serve the London travel market, which is one of the largest in the world, and certainly the largest within Europe, which is key given our focus on short-haul travel. Secondly, the more established London airports serving this major market aren't yet back to pre-COVID levels of capacity, but they are not far off. We've always been honest about the fact that ultimately we are an overspill airport. When the likes of Heathrow are full, airlines then start turning to us for basing excess capacity. From next year, not only will short-haul airlines find it harder to cost-effectively base aircraft with peak slots at those established airports, but they will also have more aircraft to find slots for. EasyJet, Wizz, Ryanair and Vueling will all be taking delivery of new aircraft over the coming years. Those aircraft will all need slots to take advantage of the recovering London aviation market, and that will bring both price and availability pressures. We are the natural solution to those capacity and cost challenges. And while we make sure we discuss the right commercial transactions that are mutually beneficial terms, our proposition will still be very attractive. It's worth expanding on that attractive proposition. We serve the London travel market, as we discussed earlier. We are easy to get to from London, particularly by train, with direct trains from Liverpool Street, with journey times essentially the same as those to Stansted, but with much shorter walking distances when you arrive. And of course, the volume of people accessing our airport by train will only grow with the opening of Crossrail, which will link into nearby Shenfield. People can quickly and easily go from train to the terminal, move through one of the UK's fastest security queues, and then enjoy our airside terminal. That easy experience is why we've won so many awards over the years. When speaking to airlines, we point to the passenger data from 40 previously proven routes. That means we can guide airlines on the likely demographics and locations of passengers looking to fly those routes, the expected load factor, and therefore the profit profile for those routes. We are also well placed to offer peak slots, which are becoming restricted elsewhere. And we have a lower operating cost, and we can reflect that in our aeronautical charges when talking to the airlines. That said, the key for us is to secure contracts on mutually positive economic terms. And while we can offer attractive terms, we will still continue to focus on airline agreements that are profitable for all parties. I'm now going to hand back to David, our Executive Chairman, for his final points.
We have made good progress in a difficult year. The key now is to build shareholder value to repay the support we have received during a challenging pandemic. Our renewables business offers a resilient base to deliver good returns given the maturing performance of that business and the increasing demands for carbon-neutral energy. We are confident in our expectation that Esken Renewables will deliver in excess of 22 million EBITDA in the coming financial year. Our aviation business starts from a low base, and given the steps we have taken to minimise cost, can now start to rebuild passenger volumes in a profitable way. We will do this with the right commercial deals as passenger demand recovers and airport capacity constraints return to London. Strict financial discipline has been the backbone of this management team's approach to both cost and cash management and is embedded in our DNA. We will continue to manage our balance sheet effectively and ensure we have the resources to address the remaining residual legacy liabilities and sufficient working capital to support our growth ambitions.
David, Lewis, Nick, thank you very much for your presentation. As you can see, we've received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. David, could I just ask you to read out those questions and give responses where it's appropriate to do so, and then I'll pick up from you at the end.
Sure. Well, thank you very much, everyone, and thank you. We've got a number of questions coming through here, so I'll just take it from the top. We'll go one from Damien. Thanks for the reminder on the debt tank. timeframe. Can you expand further on funding thoughts and also the momentum you anticipate for non-core disposals? I'm going to ask Lewis to cover the debt funding just on the non-core disposals. Clearly, we are actively working on these opportunities at this time. We'll update the market as and when things come through. I would definitely expect that we would make some progress in the current year, and we'll get some realizations there. So if Lewis wants to.
Yeah, sure. On the funding, so essentially what we've said is we are looking at funding arrangements. We're looking at banking facilities within there, and we're also looking at debt facilities as the primary solve initially. And obviously, as we've pointed out, I think there's two profiles here. There's the profile that leads up to the exchangeable bond, and then there's the solving for the exchangeable bond. So in the near term, we're looking at banking requirements, and we're looking at possible solutions around debt facilities to take us through to May 24.
Okay, thank you. And then we've got one from Rob. Thinking about new passenger airline customers for LSA, are you targeting mainly low-cost carriers or regionals or network carriers or all three? I think that's quite an easy one to answer in terms of we're actually talking to a range of carriers across the whole market and have been over the last 12 months and will continue to do so. And then there is one from Stephen, and I'm going to hand this one to Lewis, but I'll read it out. Travel is back 86% 2019 levels according to Eurocontrol. Southend has a great low-cost model. Question is, one, why do you think it is not really yet participating meaningfully in the recovery? Two, when do you think that will be? And three, from a cash flow balance sheet perspective, when does it have to be? Thank you. I think some of these you may have picked up actually.
Yeah, so let me cover that. So when you actually, why do you think it's not really participating? I think we were very clear in the presentation that this is an airport that we believe will benefit as the other airports fill in the London network. So I'm expecting to see that recovery come through as the rest of the airports fill. So we're continuing to look at that. In terms of when do you think that will be, we continue to have extensive dialogue across a number of airlines, as you would expect us to be. And those airlines are clearly looking at summer 23 these days in terms of the network. So I would expect us to be starting to get those discussions going further. And clearly, as we conclude those, we'll be able to update any that are coming through. And then from a cash flow balance sheet perspective, I think we've demonstrated we are ahead of our position with regards to cash at year end, and we continue to have a very tight focus on cash. And we also are able to manage our capital investments and capital programs to make sure that we manage that cash position as well.
Thanks, Lewis. I think there's another one here from Matthew, which I think has probably been picked up on that, but I'll read it out in any case. What are the plans regarding securing further contracted airline flying agreements with the airlines? I think just from my point of view, just to remind those of you who were on when we did our interim result presentation last November, that our strategy was very clear. We were not going to chase airlines at any cost to get them into the airport. We were looking to build, take a slower build in passenger growth, but for that to be profitable passenger growth. And that is very much reflected in the discussions which we've been having with the airlines, and will be reflected through into summer 23. There's a question here from Rob. Previously, Flybe was a big customer at LSA. Is new Flybe a potential customer? I think in terms of what Lewis has said, we are talking to all airlines. So I think we've probably dealt with that one. Another one from Rob here. On refinancing, can you remind us of the opportunity to sublease the legacy ATR aircraft? This is now more likely as recovery in the market, but also is this doable given the phased hand back to goal is fairly imminent. I think as we said at the half year, we expected that there may be some opportunity, but it would probably have a minimal impact. We'll continue to look at opportunities in the short term there, but again, I would guide that we wouldn't see that having a significant positive impact against the liabilities we have there. And this will be one for Nick. Given the rollout of biomass plants in the UK is reaching its end, where do you see growth in Esken Renewables coming from? Thanks, Nick.
Thanks, David. I think the first thing is just to repeat the year-end results, which were 20.3 EBITDA with a guide to 22 going forward. Lends to the question from Will. I think we see two key avenues for that medium-term growth. The first one is opportunity for further non-exclusive supply for waste wood, displacing others in the market. And then the second one is there are a number of secondary revenue stream opportunities with existing contracts.
Okay. Sorry, thanks, Nick. And then one from Gerald. What has supported the improvement in gate fees versus pre-pandemic levels? How do you see these developing in the coming year? Nick, again.
Thanks, David. Good question. So predominantly this is really under the banner of optimisation of infrastructure. Management team are doing a great job building on the knowledge and also the stability of the plants in our network. Combination of things, be it utilisation of storage to that optimisation point. We've got a number of strategic sites throughout the UK. When looking at those sites, there's an opportunity to sweat those assets with regards to dynamic fees. When thinking about geographical territories, so for example, there's typically more horizons in the south, less in the rest of the UK. There's also a seasonal pricing dynamic, given the summer months got more daylight, therefore there's more construction activity, and therefore fees also fluctuate to that seasonality. So the optimisation of our infrastructure is really a combination of all of those things coming together, actively managed by the management team.
Thank you, Nick. And then we have one from Damien. In aviation, please can you expand further on the ability to mothball LSA passenger services again this winter if needed? How quickly can it ramp up again, given London still faces a long-term structural shortage of reasonably priced capacity, excluding Heathrow here, as it's likely £55 per passenger charges the APD suggests it will become fundamentally uneconomic for short-haul point-to-point. Lewis.
Okay, so I think we've been very clear throughout. So we used furlough previously for managing the staff at the airport. So we've managed to maintain a large number of our team there, which has been really important to us. And what we've actually done in recent months, we've actually increased that team by 25%. So we are recovering and we are bringing employees through. So the team is growing to bring us back in line. And then what we're also in a position is that we are already looking that if we do need to mothball in winter, then actually we will take action to be able to keep the team, because what we don't want to be is in a position that we take the team lower and then we aren't able to react quickly to the market as it picks up again. So that's how we'll be dealing with all of that through next winter.
Okay, thanks, Lewis. One from Rory. How should we expect aviation EBITDA to compare to 2019 levels when passenger levels in London reached pre-pandemic levels? Please, could you outline how pricing and cost measures and inflation could impact the long-term margin outlook in this division? I think I'll say a couple of points that and Lewis can add in, but effectively we have deliberately not put guidance for the aviation division into the market at this stage, as we believe it's too early to offer meaningful guidance. I simply hark back to what I said, is that in the past, where the drive was for growth in passenger numbers at the airport, we will consistently look to have a slower growth in passenger numbers and have a profitable airport coming through. So that drives our whole approach to pricing. We are an attractive low-cost airport for the airlines, so we have an intrinsic benefit in any case. Your point about inflation and long-term margin outlook, one of the things we have had to deal with is this relatively new management team over the past couple of years is to be very focused on cost management, totally aware of every element of what we spend, and it's in our DNA. And I think this management team is nimble, can react to changing market conditions and take the necessary action on that. I don't know if you want to add anything in there, Lewis, or what do you think?
Yeah, I'd just add that we do recognise that inflation is a challenge for businesses. I think that what we have done is we did put a pay award through for the team at the airport. So even though the last 2 years have been so difficult, it was really important as part of our retention policy for the teams was to put through a pay award. So I think we recognise inflation and we have good cost control to be able to manage that situation.
Thanks, Lewis. Gerald, again, what is the pushback from the airlines you're in discussion with at London Southend Airport? What are they asking for that you won't give? I don't think it's fair to say there is much pushback. There is constructive discussions going on. I don't know.
Yeah, we're having discussions with all the airlines. You've obviously got different commercial negotiations going on, and therefore it wouldn't be appropriate to say what those discussions involve. But clearly, there is well engaged airline interaction with us.
And actually, maybe it'd be useful just to highlight the fact that we made some management changes at the airport. We do have a new business development director there, so we have actually improved the bench strength of the management team through this period at present to take account of driving the airport through the recovery and into the future. Stuart, when exactly do you estimate LSA operate as a normal functioning airport? Appreciate the effects COVID have had a major influence. So I think we are operating as a properly functioning airport.
Yeah, we're a functioning airport. We're doing both cargo and passengers at the moment, and obviously we expect through next year for that functioning airport to continue to develop and grow again.
Yeah, so I think we've probably covered that. Anthony, Esken is a shadow of its existence as Stobart Group. The metamorphosis has been painful and reductive even before the assaults of Brexit, COVID, Putin and the economic crisis. Wouldn't it be practical to seek combination with another player or even takeover? The one remaining asset of any value is Southend Airport. I think if I just draw your attention back to what I said at the time of the half year, having reshaped the group and having made the decision at that point that we were not going to consider selling the energy business, which had been the previous discussion. My view was that there is greater value to be had for shareholders in the medium term from us continuing to hold both these assets through the recovery phase to then look at how we can crystallise value for shareholders. The energy business has recovered and continues to show a growing profitable and cash generative stream. And the airport business is starting to recover, and we believe that will continue. The long-term investment thesis for the airport remains. It will be the last remaining London airport that can deal with the increase in capacity requirements, but it's also got so many attractive features to airlines and to passengers that over the medium term we have no doubt that there will be greater value in the future than there is available today. Hannah, with any fundraising, would you extend the opportunity to private investors? I think at this stage, Lewis has been quite clear. There is no proposal to raise money from investors. We are simply looking at refinancing a 20 million RCF facility in the normal course of business at present. Rob, let's talk about windfall tax at the moment, perhaps even extending to biomass as power generations. What are your thoughts on that for Esken or customers? I think, Rob, one of the things I have learned over the years is to leave the speculation around political decisions to the politicians and the press. I think at the end of the day, the important thing is that the biomass energy generators in the UK are a vitally important part of energy security. They do represent 2% of the energy into the national grid. And at the end of the day, renewables is a key focus for the government. So we just have to wait and see on that one, but I wouldn't comment any further on that. And there's a question just come in from Anthony. What's the proportion of freight traffic at Southend compared to passenger services, assuming normal activity? I think that's not something we would answer at this stage because it sort of gets us into realms of giving guidance, etc. on that. So I'll give. There are no more questions showing up on my screen here. I'll give a minute for anyone just to ask in case they've got a pressing question that they would like to raise. Just give you an opportunity to do that. And otherwise, I think there's been a good interaction there, and thank you for your questions and thank you for your participation in it. it's always surprising how quickly these sessions come back round every 6 months. But I think as a management team, we're continuing to do what we said 6 months ago. We're continuing to deliver against our medium-term objectives. Strong energy business, aviation starting to recover, good long-term value play. We will always continue to focus on proactive cost management and focusing on growth. And I've just had one last question, just to introduce a bit of levity into the situation, and it's from Alistair, where he said, "When is the next runway run?" I'm sure we will notify anyone that wants to when they can participate in that for charities. So
Yeah,
it's probably in December, is it?
Yeah, November, December time is normally
December.
when we run it. So do give us a shout, Alistair. We'll welcome you to the airport.
Okay, well,
David, if I could just come in, David, Lewis, Nick, thank you very much for that. I think you actually managed to address all those questions from investors, and we will of course publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, David, could I just ask you for a few closing comments?
I actually think I made my few closing comments there actually before Alistair came in, but just for me, I'd like to thank investors and everyone for the continued support. It has been a tough 2 years. We are starting to come through it, and I look forward to interacting with you again in the not too distant future. So thank you all for your participation.
David, Lewis, Nick, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Esken Limited, we'd like to thank you for attending today's presentation, and good morning to you all.